Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. A pullback on stocks Tuesday. Investors seeing red after weaker than expected economic data, new tariff comments from President Trump, and continued Fed uncertainty. We're going to be diving deeper into those top stories. And there's just an hour of trading to go until the closing bell. And right now, stocks lower. The Dow's down about 50 points. Your broad gauge, the S&P 500, down about 0.4%, and your tech-heavy NASDAQ down about 0.6%. Let's welcome in now. Got Chris Versace, Chief Investment Officer at Tematica Research, along with Senior Fed Reporter Jennifer Schonberger and Senior Markets Reporter Josh Schaefer, joining us to help break down the headlines. Kicking over to you, Josh Schaefer, first to give us the latest on today's trading action so far.
Hey Josh, after two more than 1% moves for the S&P 500, one to the downside, one to the upside, things are a little bit quieter today across the major indexes. You're looking at the S&P 500 off about 0.4%, the tech-heavy NASDAQ down a little bit more at 0.6%, and then we take a look at the Dow Jones. That is only down 42 points, not a large move in terms of those major indexes. Of course, I'm looking at a 10-day chart here for some of these major indexes, and that's kind of been the story too. We've gone up and down a bit, but we haven't actually made too much incremental progress. One other thing I want to take a look at while we're on this screen, the 10-year T-note. So the 10-year T-note not moving a ton right now, but this, of course, has been the big story in markets over the past week or so. It has been Treasury yields coming lower and a little bit of an interest rate trade rally as the market has priced in more Federal Reserve interest rate cuts for this year following that weaker than expected jobs report. Because take a look at this. The Russell 2000 outperforming again today. That's 2 days in a row for the small cap index, which is, of course, interest rate sensitive. That index now up almost 2.5% to start the week. So we have seen a little bit of a rally in small caps. Be interesting to see if that holds. On an individual basis, we're still getting a fair amount of earnings movers. So I do want to highlight one specific one here. Let's take a look at Palantir. Palantir surging after stronger than expected earnings, extending gains from yesterday, now up 11% over 2 days. Then if we look at a 1 year here, just to get a scope of this move, stock's up 612% over the last year for that AI technology company. It is now the 20th largest stock in the S&P 500. So that's a rally we're going to have our eyes on into the close. And then I do want to just take a look at the sector action. Yesterday, we were talking a lot about these three sectors: communication services, technology, and utilities. Those were your leaders yesterday in the broad rally. Today, they are the laggards. You're seeing a little bit of defensive tilt with consumer staples outperforming, also healthcare outperforming slightly over there. And then finally, just a look at the leaders, because again, we're seeing a similar story. Yesterday, we were talking about risk on in this market. We were looking at ARK and our IPO ETF that we look at outperforming. ARK down 1%, IPO down more than 1.3%. And then finally, a look inside that NASDAQ 100. Again, yesterday, you had a little bit of a mega cap tech tilt. Meta, Alphabet, NVIDIA, Microsoft were all in the green. Those stocks are in the red. Your one Mag 7 that was in the red yesterday, Amazon, that's in the green. So a little bit of August feel to the trading action today, Josh. Not a ton going on underneath the surface or really at the index level, kind of just wavering at this point.
And Chris, so disappointing economic data, more tariff threats we know. What do you make of today's trade?
I think the market is trying to reconcile what is the speed of the economy. A lot of folks were nervous after last week's unexpectedly lower print in the July employment report. And I personally was waiting to see, what does the July ISM services PMI tell us? It's 85% of GDP is from the services. To me, that's a much more important indicator. And it came in weaker than expected. Employment softened, inflation figures in that creeped even higher. So I think the market is saying, what is the real speed of the economy, Josh? It's lower and slower than we thought previously.
And investors, we know, still keeping a close eye on Fed Chair Powell's successor. That's in the headlines as well today, too. Let's turn to Jennifer now for more on that. Jennifer, catch us up. Well, Chris, let me get your thoughts. We'll get Jennifer up and running there. But obviously, Trump talking to press today, making some headlines of possible Powell replacements, a lot of big names being floated. What'd you make of that? As an investor, what did you make of that?
Well, I think it's obvious that Trump is going to bring someone who's a little more dovish. That's his bent. He likes to have his people supporting his agenda. And the market might get a little excited about that in terms of maybe this moves us a little closer to rate cuts. But remember, it's a committee. There are 12 people.
Yeah.
So one more, maybe it helps tilt things slightly. But I think for now, if the data continues to be like we have, even though the July employment report was weaker than expected, still 73,000 jobs, inflation ticking higher, until we see those jobs numbers maybe turn negative, endure that pain that Powell talked about several quarters ago, that we might have to go through to get inflation down to 2%. I think he's going to stay where he is, subject to new data.
All right, I think we got Jennifer up and running here. So investors still keeping a close eye on Fed Chair Powell's successor. Let's turn now to Jennifer to catch us up. Jen.
Hey there, Josh. Yeah, President Donald Trump says he has now narrowed down the list of prospects for who could be the next Federal Reserve Chair to 4 candidates. Not on that list, Treasury Secretary Scott Bessent. Trump told CNBC in an interview this morning that Bessent told him last night he doesn't want the job for Fed Chair and wants to stay where he is right now as Treasury Secretary. So who is on that short list? Well, the president said the 2 Kevins are doing well, implying that the former Fed Governor Kevin Warsh and current director of the president's National Economic Council, Kevin Hassett, are in the running. Both have advocated for lower interest rates, something the president wants. Meanwhile, Fed Governor Chris Waller is also thought to be in the running. When asked about Waller, Trump didn't deny that Waller was among the 4 possible contenders. Waller dissented last policy meeting against holding rates steady, preferring to cut rates by 25 basis points instead. Now, this news comes after Fed Governor Adriana Kugler unexpectedly announced she's resigning effective this Friday, offering the president an opportunity to fill an open slot on the Federal Reserve Board of Governors when he's aggressively been pushing the central bank to lower interest rates. The president also noted he will announce a replacement for Kugler very shortly, and that person could go on to become the next Fed chair. He says he expects to make an announcement on the next Fed chair soon. Josh?
And Jen, while we have you, how much would the person who fills Kugler's seat, how much would that tip the scales for a decision here?
Honestly, Josh, it may not tip the scales all that much. We know that he's probably going to appoint a dove, someone who favors lower interest rates because he has been hammering the central bank for lower interest rates. But that would only give you officially 3 doves, right? Because we know Fed Governors Waller and Bowman both support cutting interest rates right now. Then you'd have the 3rd person in place, but then you'd have the rest of the 19-member FOMC committee to contend with. And we know that the rest of those members remain in a wait-and-see mode. There are some that are more middle of the road, like San Francisco Fed President Mary Daly, who could be inclined to vote for a rate cut by September, though that remains to be seen based on the data. But it's not a slam dunk that one change in one position could alter the voting of the Federal Reserve.
All right, thank you, Jen. Appreciate it. Chris, I want to get your thoughts here. Here's an argument I've heard. Get your take on it. I've heard some prominent people make the following argument, that Powell should step down. And here's the reason. I'm paraphrasing. But basically the reason is he's such a target at this point for Trump that if he stepped down, it would actually help diffuse the situation. It would calm things down. Yeah. And his stepping down would actually kind of preserve the integrity of the Fed. What do you make of that argument?
I don't think I buy that.
You don't? Why not?
No, I'm an admitted Powell fan. I say that because he's a straight shooter. He follows the data, and he kind of, if you listen to what he says, you pretty much can figure out what the Fed is going to do. So I like that degree of predictability. To me, if he left, it would almost be him allowing the Fed to roll over, right? And then all of a sudden, what happens to monetary policy? Where do we see interest rates go? How fast? And what's the implication for that? Right? If we see a massive cut, like what Trump wants, 100 basis points, 200 basis points, or heaven forbid, 300 basis points like that, it might turbocharge the economy, but what does it do to inflation? How do we get out of it? So I kind of like the fact that there's a man on the wall holding the line.
All right, hold on. Let me ask you this, though. There is a question asked in certain political circles, and as a fan of Powell, I ask this. Yeah. The question goes something like this. Why did the Fed cut late last year, an election year, but won't cut now, even as inflation has calmed? You've heard that question,
So
I'm sure.
that is a great question, right? And I have to admit, when the Fed delivered 50 basis points last year, I was a little surprised, right? Because when you kind of game out the meetings, and the proximity to the election, typically the Fed doesn't do much back then. So obviously they saw something in the data that allowed them to do it. If I remember correctly, probably inflation was coming down close enough that they could take policy out of super restrictive mode to restrictive mode. Now, candidly, I wouldn't have done that at the time, too close to the election, better to wait until after. That's my view. Today, though, we take a look at, again, the July ISM services numbers, 69.9 on pricing moving higher, right? I mean, that is ticking, and we haven't seen the last of the inflation data. So to me, Powell is kind of holding the line and saying, look, we want to see what the impact of tariffs are on inflation. We're starting to see it. It is creeping higher. How can they cut against that if, like I said before, we don't see the other side of their mandate fall out of bed?
All right, so the Fed's making headlines today. Let's also switch gears, because Wall Street also keeping an eye on Trump's new suite of tariff rates. Let's get to Yahoo Finance Washington correspondent Ben Werschel with the very latest. Ben.
Josh, yeah, it's 33 hours. I counted for you how many hours until Trump's latest tariff deadline. That's 12:01 a.m. tomorrow night. So we have kind of a last-minute flurry of pushes there. I put it in sort of two buckets for folks. The first is countries that do not have a deal. Switzerland and India are the two biggest ones in focus there. The Swiss president is in Washington today. She announced a last-minute trip here to try to get away from the 39% tariffs that are set to be levied on her country there. She's trying to offer more options to the Trump White House today to do that. TBD if that succeeds. On the other side of the spectrum is India, who appears set for increased trade tensions for the short term. Trump promised today that in addition to the 25% tariff he's looking to increase it in the next day. In his words, substantially higher because of India's consumption of Russian oil. India is very much in the kind of crosshairs this week because of both this trade deadline, but also a Russia deadline on Friday over Russia sanctions. On the other side are countries that have a deal but are still negotiating on it. And there's a whole lot there. The Japanese negotiator is set to be in Washington this week on auto tariffs. Are they going to have a 15% rate on auto tariffs? Likewise, the European Union still pushing back on things like liquor and spirits. So those issues, those goods are definitely in focus. So a lot of questions about sort of what the world looks like on Thursday morning after these tariffs go into effect.
Bottom line on China specifically, Ben, are we any closer here to extending that trade truce and maybe eventually that Trump-Xi meeting?
Yeah, I mentioned the Thursday, Friday deadlines this week. Next week is the China deadline, August 12th. That's when tariffs could snap back to triple-digit levels if there's no action there. There's a 90-day pause that expires then. The widespread expectation after some meetings in Sweden last week is that there would be another 90-day reprieve, and that would help pave the way for a Trump-Xi meeting later this year. Both of those are still kind of assumed, but we've been waiting for days on that. The commentary from Trump today on the CNBC interview kind of was in line with that. He talked about how they're close to a deal. The word he used was the word he used, close, and that it made it likely that there would be a Trump-Xi meeting later this year. There's a lot to be worked out in terms of this meeting. There's kind of a semantic fight over who wants the meeting more, but the bottom line is those two still appear to be on pace for the coming days, and which would be a clear market positive.
All right, thank you, Ben. Appreciate it. Chris, on tariffs, I think as Ben was just kind of summarizing there, you got a lot of tariff headlines, cross currents, maybe a new higher tariff on India. How are you trying to wade through that as an investor?
To me, it's, if you think about last week when we saw a flurry of positive trade deal announcements, arguably they were positive. Now we're hearing all of this, and I heard exactly what Ben had to say, and I'm sitting there going, wow. A lot of uncertainty on this front still remains. And I think, considering where we are this time of year, Josh, August, September, not really great months for the market. We're kind of getting through the earnings season, and I'm sure we'll talk about it later, but earnings expectations for the back half of the year are coming down. This to me says that maybe it's time as an investor to kind of take a pause, sit on the sidelines, maybe let stocks come to me so I can find better opportunities.
Well, on trade and tariffs, what about this argument, which you'll hear folks make, which there is uncertainty, but you hear folks say, Chris, listen, Trump is a fan of tariffs, that he believes in them, as a policy tool. You're going to get tariffs. But, so the argument goes, he also doesn't want to wreck the stock market. He uses the stock market as a kind of grade for administrations.
Right.
And is the market telling you here that so far he is seeming to navigate this, to thread that needle? What do you make of that?
I think it's possible, right?
Yeah.
I mean, I think what we've seen compared to Liberation Day when we had, the expectations for high tariffs, then they've kind of creeped lower. The market's been able to wrap its head around it. Companies have been able to wrap their head around it. Even companies that originally said, we can't figure this out, we can't give you guidance.
It is an interesting theme on the earnings, to your point, how you are hearing CEOs saying, some at least saying, listen, we can mitigate this. There are levers we can pull. That's been a theme.
That has been a theme. There's been a little more clarity, right? But again, we've got some extensions going on, this other rash of uncertainty. I'm really kind of curious to see what retailers have to say in the back half of the earnings season because, consumers, continue to pull in their spending a little bit. And those retailers are really going to feel the brunt of tariffs, especially on the China front. So it'll be interesting to hear what they have to say.
And even those retailers too, Chris, I just think about those retailers who thought, okay, I'm going to make my move. I'm going to move production to in India. Now you're thinking, well, I just heard there may be even a higher tariff coming there.
Correct.
Right. So how do you navigate that?
Well, I don't know. We're going to have to wait and see how the landscape evolves. This has kind of been a constant theme, right? Almost week to week, what's unfolding out of Washington? How does it push us one way or the other? And we know it's going to change again because we were told today, before too long, expect tariffs on pharmaceuticals and chips. Chips. That's been the big story.
It will. All right. Thank you, Chris. We are just getting started, meanwhile, here on Market Domination. Coming right up, First Watch serving up its earnings. And we're talking directly with the CEO to learn more about the company's performance. Going to tell you why digital insurance company Lemonade is trading up today as well. And Caterpillar may be digging out of a tough time. We're taking a deep dive into that stock, too. Those stories and more coming up when we return. Stick with us. Let's take a look at First Watch Restaurant Group, the Florida-based daytime dining restaurant known for its breakfast menus, employs more than 15,000 workers. First Watch has 600 stores in the U.S. across 31 states with plans to expand into 6 more. This comes against the backdrop we know of inflationary pressures and consumer pullback that is plaguing the broader restaurant sector. First Watch's stock having a rough year itself, down more than 16% over the last 6 months, but the stock is rallying today after reporting second quarter earnings on Tuesday. And joining me now is First Watch CEO and President Chris Tomaso. Chris, it is great to see you. So you reported results, Chris. It looks like you raised your annual adjusted EBITDA forecast range. Looks like you reported second quarter comparable store sales and adjusted EBITDA that beat, Chris. The stock's popping about 3% in today's trade. Walk me through the results, Chris. What are you seeing in the business?
Yeah, we're seeing great momentum in the business right now. Positive same restaurant traffic, positive same restaurant sales. The underlying trends that we're seeing are very, very encouraging for us. And so, and we're also seeing some relief on the cost side. So we've been dealing a lot with, higher egg costs due to avian influenza. We're seeing that subsiding. So all of those factors led to us, updating and raising our guidance.
As you try to navigate those costs, Chris, what are you doing with pricing?
We've been very conservative on pricing. Our philosophy in general is to price to cover what we believe to be permanent inflation. So a lot of what we've seen this year, and by the way, the first quarter and the second quarter, we saw some of the highest inflation we've ever seen. We've underpriced because we believe it's transitory, and we don't want to pass those permanent price increases along to our customers. So we weathered the storm a little bit in the first quarter. We've gotten our restaurant level margins back to the range that we target for the second quarter, being very conservative on pricing. So we typically price 2 to 4% a year just to cover inflation. We projected our inflation this year to be high single digits, and now we've lowered that to 5 to 7%. So we're still pricing below inflation, and we think that's the right thing to do for our customers. And it seems to be resonating with them. We'd rather have the increased traffic than try to cover all those costs.
And Chris, we're always looking for line of sight in the consumer, and you certainly have that. The consumer dealing with a lot of cross currents right now, tariffs, recent economic data would suggest a softening. How would you characterize the consumer, Chris? What are you seeing? How healthy, how resilient?
I have to say, headlines aside, when we look at our customer base, we see health. We don't see any check management. Again, the increased traffic and the sales that we're seeing are very encouraging. When the customer comes into our restaurant, they're not managing their check at all. They're opting for the full experience. So we're encouraged by it. We do appeal to a higher income demographic, and we think that's been part of what's helped us. But overall, if I weren't reading the headlines, I would say we have a very healthy customer at First Watch, and I know the consumer environment is a little bit different right now, but we're encouraged by what we're seeing.
Let me ask you, Chris, we do see this data. It does suggest some weakening. You all specialize in breakfast and brunch. To the extent that things did get wobbly, Chris, is that a meal that maybe folks would be more willing to skip and stay home for? Is that a risk?
It is a risk. I think it's something that we saw last year. But what I think we're seeing this year that's actually offsetting that is the consumer's desire for hospitality and a full service experience. And that's what we deliver. And we're also right down the middle of the fairway of consumer trends. You see some of our beautiful food and beverages right there on, consumers wanting to eat more healthy, wanting to understand the provenance of their ingredients and the care that it's prepared with. We're known for healthier options, fresher ingredients. We have, no microwaves or heat lamps or deep fryers in our restaurants. We make everything fresh to order, and that's a long-term consumer trend that right now we think is trumping maybe the optionality of the breakfast occasion.
Chris, the labor market might not be as strong as we thought. You saw that jobs report we just got. Mm-hmm. You all employ a lot of folks, Chris. I'm curious about the trends you're seeing, how the jobs market looks to you. Are you all hiring, Chris?
We are absolutely hiring. I mean, we're a growth concept. We're the fastest growing full service restaurant brand in America. And I think our unique employee proposition allows us to not have the same kind of challenges around hiring that other concepts might have, because there are growth opportunities, personal and professional growth opportunities for folks in our system. So when you think about us, we're opening about a restaurant a week right now, and the opportunities that creates for hourly employees, managers, above restaurant leadership, it really is unmatched. And not to mention, we're daytime only, so we have no night shifts ever. So that employee proposition and those core brand tenets that we were built on are really kind of keeping us above the fray as it relates to the labor environment right now. Our turnover has historically been about 20 points lower than industry averages, and it's only gotten better for us over the past couple of quarters.
Chris, most analysts on the street believe your stock is a buy here. They're believers. The stock is down, though, nearly 10% year to date. I'm just wondering, Chris, do you think there's a part of your story that maybe is underappreciated by investors?
I absolutely do. And I'll go back to the point of us being the fastest growing full service restaurant company in America. There's nobody opening restaurants, full service restaurants at the clip we are. And we've been doing it for a number of years and have, what we call a playbook that works. And we work across all geographies. And I think that growth element of our future is underappreciated for sure. And I think our track record of performance on the same restaurant sales front and the returns that we get are underappreciated as well.
Chris, great to have you on the show today. Thanks so much for your time. We appreciate it.
Thanks for having me. I appreciate it.
Well, consumers have been proceeding with caution when it comes to their spending amid economic uncertainty. Companies such as Procter & Gamble and Chipotle have been pointing to challenging consumption trends, but Wall Street getting more color on the consumer as McDonald's and Dutch Brothers now gear up to report their quarterly results. Chris, let's talk about these names. Let's start broadly. I'm interested to get your take. When you look at the consumer right now, we can point to different cross currents, tariffs, economic data, recent economic data. What do you see with the consumer? How would you characterize it?
Well, the consumer continues to spend. We see that in the data, but it's increasingly more selective. Coming out of the pandemic, there was a lot of conversation about spending on experiences, right? And we still see some of that. The travel outlook for the back half of the year looks pretty good, but at the same time, when we see, comp sales being lowered at like Kroger or some of these other companies, it tells you that consumers are being very selective in where they are spending. And I think that trend is going to continue to the extent that we see a softening in the employment market. I think we're going to see people retrench back even further. So the disposable spending, that's the area to watch. If we start seeing savings build up and disposable spending coming down, it's going to tell you that some of these more discretionary related retail stocks are going to have a tough time.
Let's talk about some specific names here. Earnings on deck. McDonald's on deck there. My colleague Brooke Tapama says McDonald's expected to report a return to sales growth when the company releases results. Global comparable sales expected to grow 2.49%, led by international development markets. Your expectation there? Stock has not done much this year.
No, it hasn't. And I think, if I could cherry pick from your conversation with First Watch, right? They're continuing to grow. But what really stuck out? Right? Their margins are still going to be under pressure because their inflation pressures are higher than what they're pricing. That's the concern I have with a company like McDonald's when we see beef prices going higher, chicken prices going higher. They might deliver on the top line, but it's the profit growth that I'm concerned about.
One other name. I want you to check on Dutch Bros. Now,
Love it. Love it.
You love it. The street broadly bullish on this name. It's up about 10% this year. Why do you love it?
So this is a classic geographic expansion story. It is time tested. And if you look at the saturation level compared to a Starbucks, even when they hit their multi-year plan, they still have ample room to grow, and they're moving into food, another out of the Starbucks playbook enhancer. So I think that this is a great company to own. The stock is not only, you say it's up 10%, but it's well off its highs of the year. I think that's the opportunity. One of the issues with Dutch Bros, they're kind of a sleepy company. There's not a lot of headlines out there. They're not in NVIDIA, so they're not, getting all the buzz. So you like that coffee and buzz?
Yeah.
But anyway, so I think when they report, it'll allow people to revisit the story. They'll see that the growth expectations are still tracking. I think that could reinvigorate the story. And by the way, for folks who are concerned about higher coffee prices, management's been really clear that coffee is nowhere near the amount of its COGS that people expect it to be. It's less than 10%.
All right, cautious of McDonald's, bullish on Dutch Bros. So says Chris. Thank you, sir. Now time for some of today's trending tickers. We're watching shares of Eaton, Caterpillar, and Lemonade. Eaton stock, let's start there. It's fallen after announcing third quarter guidance for the company that did miss expectations, spurred on by tariff costs. So this one in the red, Chris, narrows its full year adjusted earnings per share forecast, it looks like. Noted that there was a high bar on this one, and that's what KeyBank kind of pointed out. KeyBank, by the way, likes this one. They said, view the results as encouraging update. Did think shares could trade lower near term, given, they point out, the high bar into the print. They said due to well-documented data center strength. Most on the street still like this one, but what do you think?
So we like it, we own it. And I agree that it was a high bar coming in. The stock, like a lot of names, had a very, very strong run. My thinking coming into the earnings season is that, stocks that have had tremendous moves, in order to move higher, they have to deliver a beat and raise. So flip it around, a beat and reiterate, or a beat and, modest guide down.
Not going to get done.
You're going to see some pressure on those shares. That's what we're seeing. But the KeyBank guy is correct. The data center orders were up 55% year over year. That's where the strength is. They had strong print in aerospace as well. The weakness is in their vehicle sales. No surprise given tariffs. So you're seeing a stock kind of get beaten up for guidance for the current quarter that on a $3 number is down a couple pennies. Does that make sense? 7-8%? I don't think so. Let's focus on where the tailwinds are blowing, and that's driving over 90% of the profits.
All right, next up, I want your take on this one too. Caterpillar, missing on the top and bottom lines in the second quarter. The industrial giant projecting a net impact from tariffs of $1.3 to $1.5 billion for the full year. So does expect to face, Chris, these net incremental tariffs. CEO did say the company will be able to offset the impact, saying we're going to mitigate the impact of tariffs, talk about exactly which levers the CEO is saying we're going to pull. We're looking for a little more clarity before reaching into those. We have heard many CEOs that talk about tariffs. Some, as we talked about, seem to suggest that there are levers they could pull to mitigate, whether that's cutting costs or raising prices or maybe leaning on their suppliers. But what do you think about Caterpillar?
So it's an interesting story, right? Construction equipment, we know that there's a lot of that activity going on in the States, whether it's data center, non-residential construction. I would favor more like a United Rentals and the rental companies for that. But as it relates to, Caterpillar, what about their non-US sales? What about the impact of the dollar? How is that changing in the back half of the year for them? To me, this is more of a wait and see story. Maybe some clarity on tariffs can help someone get more bullish on that name.
All right, final one here. Check out insurance provider Lemonade, rising on their Q2 results, including a beat on revenue, a better than feared loss per share. In a letter to shareholders, the company ascribes the better than expected quarter to acceleration in growth, underwriting performance, and expense management. The insurer also raising revenue for the remainder of the year, spurred on by reinsurance renewal and reiterating that EBITDA outlook. So this one in the green today. Boost the full year revenue guidance, Chris. Now sees between 710 and 715 million. I do see analysts at Jefferies cited as saying many underwriting metrics they said were better than their and consensus forecast. Stock's up about 30% this year.
Yeah, it looks like a champ.
Yep.
When I was kind of reviewing it, the thing that stood out to me is how they're leveraging AI to do this. So it's another, example, Josh, of AI helping drive, improving cost structures, productivity. Kind of keeps me bullish on some of the other names that are out there that have yet to report.
All right. Meanwhile, Fizer shares, they're rising after upping its profit forecast for 2025. We're talking directly to the CEO when we return. It's an interview you don't want to miss. Fizer reporting a beat on revenue and earnings for its second quarter, but the pharmaceutical manufacturer is facing new hurdles with tariff threats and calls from President Trump to lower prices. Our own Julie Hyman and senior health reporter Anjali Kamlani spoke with the CEO about cost-cutting efforts and the future of the firm.
I would call it more its productivity enhancement and margin expansion. We do that by implementing three things. One, it is focus. So we stop doing things that they are not that important, and we double down on things that they are. The second is technology. Technology right now offers tremendous opportunities for improvement of productivity, particularly AI, and simplification of our business processes. There is a lot of waste that is happening when you have complicated structures that requires usually more people than if you have streamlined your areas. And this is where we are. We have announced a program that we are on track to exceed actually this year. And then we announced an additional 1.7 billion of cost reductions. 1.2 billion of that will until 27 will happen in SI&A, in administrative and marketing and selling expenses. And that will fall to the bottom line. 500 million will happen in R&D, and that will be reinvested all back in R&D.
So it's not just the cost cutting, though. Obviously, investors also want to see growth on the top line, growth in revenues. You guys did have growth in revenues this quarter by 10%. And the revenue growth has been more volatile. So how do you keep that momentum going and also find stability?
Yes. If you see the elements of our revenues, the volatile pieces mainly are COVID, because COVID could happen in different quarters every year. Usually there are two waves every year, and in sometimes like 23, the one wave, the summer or the winter are stronger, and the same is in 24. So, and it's different year by year. So I think that's the variability. The rest of the business, it's a very strong, continuous growth momentum, I think, and new products and recently acquired products contributed $4.7 billion in this first half of the year, and they are growing at 15%. So it's very solid.
I do want to talk about the backdrop from Washington, because that's something that affects not just you, but the whole industry. You're also currently the head of the Pharmaceutical Industry Association. You did say on the call that you have a special relationship with members of this administration. Of course, we've heard the president be critical of the industry. What do you feel you have been able to educate President Trump about to sort of better help him understand the industry's perspective?
Yeah, I said we have a special relation with the president because that relation was cemented during the COVID crisis. He was very concerned and he wanted to make sure that we speed up the development of vaccines. So we speak every second week. So he was very active. And he would ask about studies and where we are and what can we do to accelerate. So it was very, it was a bonding, let's say, exercise. No, I think he's educated. Of course, he doesn't go into the details. It's not his job, but he understands the dynamics. I had multiple times the opportunity to discuss with him the impact that the middleman has in the prices in the US, and he understands this very well, and he speaks very vocally about it. Other things that they are subsidizing, that they are taking out of the prices of pharma, so that the patient pays a lot, but then we don't collect all of that because it goes to other areas like 340B. So what he wants to achieve it is to have a better deal. He's very competitive. He doesn't like that others paying less. And he wants to fix it. And we are very productively discussing right now what we can do on that.
And the president did say in an interview today that tariffs could eventually reach 250%. He's talking about a phase-in of that. Are you confident that you'll avoid that outcome for the industry, that 250% on imports of pharmaceuticals?
I don't want to speak for the president, but what he said today, which was very important also, was that it will be a very small tariff in the first couple of years, and then he opened actually the window for a grace period, because I had this discussion with him, and I had this discussion with multiple other members of the administration, that a manufacturing site to be completed takes more than 5 years for our industry. In North Carolina, we just completed, but we completed recently, a few years back, the build of one manufacturing site that was one product only. And it took us 4.5 years, and that was our record. So you can't just say you need to do it immediately and pay tariffs until you transfer it. We can't afford to pay tariffs and the investments to transfer.
Right, it makes sense. I want to bring in our Anjali Kamlani, who of course you also know, our senior health reporter, to talk more about some of these issues. So Anj, I know you're also, of course, watching the pricing debate very closely.
Yeah, that most favored nations clause. Albert, I love the letter, got your special, name crossed out on there from Trump. But going to the contents of it, I know you've already talked about the DTC push and getting that direct consumer push. You've already unfolded a strategy there, so you're really ahead of the curve there. But I want to actually talk about the pricing part of it, because we've had notes from analysts talking about how it's really unfeasible to do most favored nations pricing the way that it's laid out in that letter. Can you talk to us about how you're planning for that?
We are planning for all different scenarios of different ways of implementing something like that. And we are discussing and making mitigation plans. But we don't know how that will end up. We are still discussing it with the president, how and what will be. The devil could be on the details in this stage.
And talking about the tariffs as well, I know that with the manufacturing push, the industry had been trying to really pull the president away from these tariffs and conversations around it with the more than $200 billion in investments. Explain to us how that works, considering that 90% of prescription drugs are generics, and those are the ones that are cheaper to make, come from overseas, have smaller margins, therefore not really appealing to companies like you to produce. Meanwhile, the branded drugs are mostly produced here with the APIs coming from overseas. So can you just put it together for us on how it would really impact you with tariffs coming in? What components?
Depends on the product and depends how the custom authorities define a country of origin. First of all, you're right that generics are more than 9 prescriptions per 10 in the US. And those are the cheapest medicines anywhere in the world. The generic prices in the US are the cheapest of any medicine. I think, again, patients are paying way more than the real price of the generics because of ways that the insurance system and the benefits work. But even with that, they are the cheapest generics in the world. Then the 10% or less that they branded, many of them are manufactured here. As you know, probably we have 13 sites in the US of manufacturing. 11 are manufacturing plants, and then 2 are gigantic warehouses, almost like a plant. So we do a lot of them here, but over the years, we produced some stuff outside. And Ireland is a typical example, Switzerland is a typical example, other places are typical examples. And those, we need to understand if they will be, the API will dictate the country of origin or where the final product is made.
Stay with us. We have an expert picking stocks that may be a good buy or leave you saying goodbye. Coming up after the break. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. And I'm here now with Tematica Research Chief Investment Officer Chris Versace. Chris, great to see you. Let's go through, first of all, let's start with one you like, and that would be Axon Enterprise. Now this one, popular name, it's got a lot of fans. Of course, we know that stock's up about 45% already this year. You say the good times are going to keep going.
Yep.
So let's go through the reasons why. One, you say shifting mix toward higher margin.
Yeah, so most people think about Axon as the old business they have, tasers. Some might say, oh, body cameras are increasingly drones, and they have that. But the real secret sauce here is the software and services business, much higher margins. Gross margins are around 79%, 51% for the hardware business. So as we see that higher margin business continue to grow, that positive mix shift is going to drive overall margin expansion, drive cash flow, drive earnings.
All right, second reason you say this is one to buy. Addressable market, future contracted backlog.
So who are their customers? It's primarily public safety. So when you think about police officers or even federal agencies, they have long buy cycles. So we have some nice visibility for Axon. Their current future contracted backlog, $10.7 billion. Josh, consensus estimates for this year, $2.7 billion. That's a lot of runway.
All right, third reason, you say this is when you'd still commit capital to, AI adoption rising.
Yeah, so in that software and services business, they are helping public safety address the shortage that they have in terms of police officers. We're seeing that give a rise to AI-enhanced services, which have even higher prices, higher margins.
All right, you made the case eloquently, smartly, Chris, as always. Before they pile in, talk to viewers about maybe some downside risks you need to have on your radar.
Well, I would say this, that coming into the company's earnings report last night, the stock was around 750s, around there. Huge reaction in response to this. I think some of it is due to short covering. There were about 2.5 million shares that were short. Let that blow through the upside, right? Let that short covering happen. Let Axon shares settle back down. I think you get a better price if you wait a couple days.
All right, so Axon is a buy. Let's talk about one you say you would avoid, and that would be Byrna Technologies. This one is down about 20% already this year. Let's go through some reasons why, Chris, you say, you would still avoid it, even at these levels. You say, one, concern over consumer spending.
Well, let's talk about what Byrna is, right? So they are non-lethal safety weapons, right? But their addressable market is largely consumers. So think of our conversation earlier, Josh, about the consumer kind of retrenching, pulling back, and it could get worse depending on what happens to the employment market. Here you're talking about a price tag that's, depending on the low end, $300, as high as $600, $700. And when the management team tells you they're seeing sticker shock, that is not a good thing.
Second reason you say this one is one to avoid, retail heavy distribution.
Right, so unlike Axon that has this long pipeline, this high degree of visibility, this is really Amazon, Sportsman Warehouse, so it's, there's no long backlog to help give us confidence that there's a very long runway here. This is sale to sale to sale, very reliant on the consumer.
And a third reason you would avoid this one, record high inventory.
Well, yeah, that's exactly what the management team said when they reported their last quarter. So you tie that with the consumer potentially pulling back. My concern is high inventory goes even higher.
All right, so you say you avoid, but fine, let's end here. What would be upside risk to that call?
So the upside risk, or what would turn it around, why could I become more positive on the story, is if we see some things that are more in line with what Axon does. So do we see a recurring revenue model come out? Boy, that would be nice instead of sale to sale to sale, right? A little more predictability in the revenue stream. The other would be if they move past the consumers into the public safety market. So effectively, if they became more Axon-like.
All right, we'll leave it there. Buy Axon, avoid Byrna. Thank you, Chris, and thank you all for watching Goodbye or Goodbye. While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.